If you invest in real estate, you should do it only with a positive cash flow, right? I mean, it would be cool if that works, don't get me wrong, but that's selling you a dream that doesn't exist. Here's what I mean by that. This is a brand new property in the middle of Munich for 34 million euros. Would be absolutely awesome if you walk into the bank like a boss, get 34 million from them, or 36 million with closing costs. What the heck, let's also add a couple of thousand for your next vacation on it. What does it matter? And then you cash flow 1 million every year and get rich without doing anything or investing any of your own money. Absolutely perfect, right? But how is this supposed to be possible? Can any one of you watching explain this to me with realistic numbers? How is this supposed to be possible? But you know what? You don't need positive cash flow in order to have a great investment. Why not? I'll tell you in this GermanReal.Estate FAQ. Let's calculate with more realistic numbers and take 100,000 of property value, because then you can just 2x or 5x our calculation in case you want to buy a bigger property. What's a realistic return on rent for a good investment property in a good location? The clients we have at Perfinex buy properties with 3% net return on rent in Munich, 3.5% in Berlin, or 4% in Cologne. Net. Just as an example. I know that there are also properties with 6% or 8% return on rent at the back end of nowhere, but these are usually crappy shacks where you have to be extremely lucky to find a tenant in the first place. And this would also make the calculation look a lot better than it is in reality, and I don't want to be one of these fake internet telling you how to get rich quickly with their stupid course. So let's take these properties with a normal return on rent. Let's calculate with 3% flat in order to be very conservative in our approach. So for every 100,000 euro in property value, you get 3,000 euro rent per year. 3% return on rent. Net. But that's not all, of course, because you also need to pay the mortgage. Or did you buy the property outright? Probably not. And even if you could afford to do that, it would be an extremely bad decision from an investment perspective. We talked about the down payment dilemma in the video that was released on the Perfinex channel today actually. Link it is in the description if you want to check it out. So, mortgage. What's the realistic mortgage rate as of making this video? Depends on how long you want to fix your interest rate. It could be 3.8%, but let's calculate with 4%, again, to be conservative. I know in the real world, the calculation can be a lot better than what we're calculating here. But then that's good, right? If we calculate with made up numbers here to sell you a dream that doesn't exist, it's not good. No bueno. Aside from the 4% interest rate, what else do you have to pay to the bank? Principal, because they want their money back at some point. And I know that there's bullet mortgages where you pay principal at the end to increase your cash flow. I also know that there's 1% principal mortgages, but almost everyone watching will get a 2% standard principal mortgage, so that's what we're calculating with. Summing it all up, you are minus 3% or minus 3,000 euro negative cash flow every year for every 100,000 euro property you invest in. Ignoring the closing costs here because we focus on cash flow in this video. And negative cash flow is bad, and you shouldn't engage in an investment like this, right? That's the narrative on the internet. And if you follow that logic, then go ahead. I'm not gonna judge. If you want cash flow, then you can go to our website right away and get up to 12% interest per year, or 50% profit share. The link to our GermanReal.Estate marketplace is in the description. But the calculation is only halfway done. That's what the gurus on the internet seem to forget, because your negative cash flow is pre-tax. And real estate, if you really understand the investment, is one of the best, if not the best way to save taxes. Why? Because you can deduct all costs you have with your rental property from your taxes. Investment properties only, not home you live in yourself. And that's why we are big fans of investing in real estate here on this channel, and not so much fans of buying a property for ourselves. It works very similar to the tax declaration you file every year anyway. Finanzamt thinks that you made that much money from your job, so they tax you on that amount. And then you come with your tax declaration and say, hold on Finanzamt, not so fast. I had this much in costs, so my taxable income is now only this. Now please tax me on this amount and not that amount. That is, in very easy terms, your tax declaration. And it works the same way with income from real estate. You make rental income, sure, but you also have costs in order to make that rental income. And with a taxable income of more than 62,810 euros a year, you have a tax rate of 42% here in Germany, the blue line. Meaning, for every euro you spend after this 62k on tax deductible stuff, you get 42 cents from Finanzamt when filing your taxes. Let's apply this logic to our little investment example. The biggest cost is certainly your mortgage, but not the entire mortgage, only the interest you pay and not the principal. We had a 4% mortgage rate to deduct from our taxes with our 42% tax rate, which equals a 1.68% real benefit. What's the second biggest cost? Cost in quotes because it doesn't exist in real life. It's just an air booking, as we call it in German. Depreciation. We talked about this in a previous video. Basically, your property is losing 2% per year, next year it's 3% per year, from a tax perspective. In the real world, properties tend to rise in value over the long term, but from a tax perspective, they depreciate in value. Which is cool, because it gets us real estate investors tax benefits and increases our return even more. With properties that finish next year, we get 3% depreciation times 42% tax rate, which is a 1.26% in real benefit. You have other costs too, property manager, insurance, Nebenkosten, but let's ignore these here and only factor in your interest rate and your depreciation for your taxes. And ta-da! What do we see here? People good in math figured it out already. You are minus 3% negative cash flow pre-tax and get 2.94% from Finanzamt when filing your taxes, which leaves you at 0 cash flow on an after-tax basis. 0. Of course you need a taxable income of more than 63k to make that work for you. If you have an income of 20k only, the calculation is gonna look a lot different. And now you can hopefully see why I don't give a single about buying properties with a negative cash flow, because it nullifies itself out after filing my taxes anyway. But why is real estate a good investment then, if you are left at 0 on a cash flow basis? 3 reasons. Your mortgage includes a 2% principal, right? So every year you are buying more and more of the property and owe less and less to the bank. 2,000 euro every year in our example. Also, rents tend to rise over time. My personal rent contract has a 2% increase year over year. So if my landlord bought with a 3% return on rent, next year he will get 3.06%, 3.12% the year after, and so on. The property will become more and more profitable until it eventually becomes cash flow positive even before taxes. But this is gonna take some time if you don't make a down payment, of course. And last but certainly not least, property prices tend to go up over the long term, if you bought a good property in a good location, that is. And the increase in property value is what we didn't even factor into our calculation. And the best of all, you can cash in their profit completely tax-free after holding your property for at least 10 years. And that's, ladies and gentlemen, why buying a property with negative cash flow might be the most profitable investment of your entire life.